Hi, everybody. Boy, we've got a healthy crowd with us today, this afternoon, this morning, whatever it is. It is Monday in Minnesota. We have a heat wave going on after our last week, so it's just awesome. I hope everybody's feeling good on a Monday. I'm Michael Matheson, M2 Financial, joined by two of our wonderful advisor teammates, Susan Anderson and Marie Henrichs. And believe it or not, we're in the same room. Maria's right there and Susan's right there. So yeah, say hi, everybody.
Good morning.
So we thank you for taking some time today to check in with us. And as we've done for years, we want to, in a group setting, let you know kind of where we think things are heading for this next year. It's setting up to be kind of a crazy year, but what year hasn't been crazy in the last 3 or 4 years? I try to remove that word just in general from my vocabulary, and it keeps slipping back in. I mean, think of the things ahead that we've got, or things that are going on. If we look in the rearview mirror, we've got ongoing wars in our world. We've got an election coming up that's already just been wild if you're watching the news. In fact, I was tuned in this weekend, flipping as I do between two different news channels. And it's so crazy how different, as always, the messaging is in both channels. So we'll talk a little bit about that as we move forward as well, and just kind of give you some thoughts as to what we're looking at and where we're headed. Of course, we have to, it wouldn't be the same without the, next slide, please, the attorneys chiming in a little bit and saying everything that they say here, opinions voiced in this material are for general information only. All indices are unmanaged and cannot be invested into directly. And then we've got risk considerations to talk about as well. So the biggest one here, I just wanted to point out, stock invests involving risk, including loss of principal, and bonds also are subject to market and interest rate risk if sold prior to maturity. So I'm going to touch specifically on that later today as well. So as we move forward, we're going to just kind of dive right in. We got some feedback from some of our guests the last couple of times we did this, that those little questionnaires that we did at the beginning weren't super helpful. So we launched a lot of that stuff. So instead of 4 hours today, we're down to 3 hours. So we're pretty excited about that. So welcome again on behalf of M2 Financial. We're going to dive into some of the content pieces.
Yeah, definitely. And now, looking back on the last year, how do we really sum up 2023? Well, stocks did amazing this last year, and yet very few expected that this time a year ago from today. So, sometimes it does pay to go against the crowd. Also, those we consider heroes might not be what we think. For example, take Sam Bankman-Fried. Fortune magazine featured him on their cover, questioning whether this crypto billionaire would be the next Warren Buffett. Less than 3 months after they had him on their cover, the public had its answer, where the richest crypto person went bankrupt because of FTX.
And not that we've been talking about crypto being an enhanced version of Las Vegas. I truly believe that at some point crypto will be something, but it's in its infancy. And like cars, radio, television, even electric cars to some certain extent, all of the front runners, none of the front runners, in fact, if you look at those industries, it's really interesting, ended up being the survivors of those industries. So we don't know where that's headed, but we know that it's been a tough, strange time in that space.
And now the market. Well, as most of you probably know, the market is forward-looking. And here we are looking at the forward earnings expectations going forward. And earnings are expected to hit an all-time high in the next year. And that shouldn't be a bad thing for stocks or the economy. Additionally, on the right-hand side, the profit margins have increased this year. Another thing that might surprise many investors.
Yeah, and I think what's really interesting about that too is that profits are increasing, so corporate America is paying attention to the bottom line, and Wall Street's been paying attention too. So that little Santa Claus rally we had at the end of the year was unexpected. Nice, don't get me wrong, but unexpected, right, Marie?
Absolutely. And it's nice that the markets are forward looking, but there are some things that we always have to remember. The average year might gain about 9%, but not all stocks are going to see the same returns. Some larger moves are normal and some smaller moves are normal.
Yeah, no question. And we saw that this last year. We remember talking about the big seven pretty much all year, the seven big tech stocks that really kind of fell asleep at the beginning of 2023. And the value stocks, the sleepy kind of old school stocks started creeping up there. And then all of a sudden, roaring back to life, completely unexpected came the big seven, which also kind of, what's interesting, that was summer, early fall. We get into late fall, early winter, we start to see the old school value stocks start to pick up and start to move forward and start to march, and which just doesn't, well, it made sense because those stocks were trading at an incredible discount compared to some of the giant companies out there.
Yeah, and it's been a year, as Mike was talking about there. Our own leading economic index, which is a combination of the most relevant economic data points for the economy, does not point to a recession right now, which is something we've been talking about for quite a while. Instead, it says the economy is running close to trend. Household balance sheets are also strong thanks to rising asset values, while debt loads as a percent of disposable income is low relative to history.
You know, and that's the R word. We've been talking about the R word for forever, it seems like. I mean, I think the Federal Reserve has done its best to put a bit of a chokehold on the economy by raising interest rates and trying to stop inflation, which inflation, of course, is caused by too many people chasing too few goods. And we have the historic inflation and historic interest rate increases in an attempt to stop that. I'm in a little bit of a disagreement with this slide because things have changed a little bit since these were published, and of course we have to go through a approval process to be able to even talk through these. I think that I'm almost coin toss right now with recession, but I don't think so. I think our most recent memories of recession, right? The one we don't remember at all because it happened during COVID. We had a couple of quarters of downtime, and then all of a sudden the economy came roaring back. We don't even remember it. I think everybody remembers the R word as what happened in 2009, 10, 11, some really tough times where essentially our economy was train wrecked by lying, cheating, and stealing on Wall Street. I think if we enter recession, we might be entering it in a different place. And that different place is coming from a place of strength and stability, which actually is part of the normal business cycle. In fact, it might cause Wall Street to say, all right, we're here. We're at recession finally after all of this. We got to the point where things slowed down. What's the next part of the cycle, which is back to the growth pattern. So it's really unpredictable, I think, what these markets are going to do if we do enter recession. And one of the things that we're looking at is actually the labor market. I think the Fed made it very clear a year ago that, hey, we want to slow, we need companies to stop hiring. We need companies to stop growing. And the labor market has been surprisingly strong.
Yeah, that's for sure. The labor market remains strong with prime age employment population ratio closest to the highest in more than 2 decades. Hiring has eased since 2022, as you can see in the graph on the left-hand side here, and going towards early 2023. But that's just normalization. The key is that layoffs remain low.
And it's been strange with our small slice of the world. We've had probably more layoffs in the last year than we've had in the last 5 years, 6 years, including the COVID dip, which I didn't know what to think of that. And what we're seeing now, though, is that I'm not only hearing from our clients, but also I ask people, so who do you know that's been impacted, yada, yada, yada. You've all probably been subject to those silly questions from me and my team here, but I'm curious, and I'm literally starting to feel that more people are being impacted in the labor market even today, and on all ends. I think it started at the higher end where companies were literally saying, okay, we think something bad's going to happen, so we're going to lay off some of our higher end salaries. I think it's starting to happen kind of in the middle section right now too, where companies are just tightening their belts. So I think that companies still see that there's still some rough roads ahead, and one of those rough roads that we have to deal with, of course, is inflation.
And recently, inflation has pulled back significantly from when we look back to June of 2022, where it was at its peak. This was mostly on the back of falling energy prices, but now most other major categories are also seeing disinflation. Plus, there's more to come in 2024. the Fed's preferred metrics, like the core PCE inflation and core services ex housing, which are running below 3% over the last quarter.
Yeah, and inflation, as we see just on the chart, man, it was out of control for a while and big time in the news. And that's what the Fed, of course, was trying to fix. So now, always there's the counter, right? That there's still really the employment piece is still strong right now. And with the employment piece still being strong, people are still making money, which means people are still buying stuff.
Yeah, a strong labor market and lower inflation means incomes are growing even after adjusting for the inflation. This is going to be a continued boost for consumer spending, which makes up close to the 70% of the economy. As you can see here from these two graphs, and incomes are rising and people are spending money.
Well, and I think Marie was talking about her Target run this weekend, so we know that Target was doing all right. And I don't know if you know, I've got a 14-year-old daughter that she has probably the consumption capability of most small countries in our world. So if any of you have teenagers, you know that that's absolutely the case. So strong consumption, you know, really the hope of low inflation, and hopefully more of that to come, continuing in 2024. It means the Fed has the potential of making some changes.
Yeah, we're hearing a lot about this. Lower inflation and the prospect of more to come in 2024 means the Fed could ease up on the rates, and potentially lower rates sometime in 2024. We're hearing a lot of speculation about that in the news. The fact that rates are as high as they are means they have room to cut, especially if we get a few months of weak data and the risk of recession rises.
You know, and that's another one, right? So this was written probably a month ago, and we're starting to see some of the Fed actually back down a little bit on some of their, you know, more, hey, we're going to cut. And I think that they finally got the message that, hey, this thing just doesn't get fixed overnight. Last year, they were saying, what the heck? Why haven't people stopped spending? Why haven't people done this? Why haven't people done that? And the fact is that it takes a long time, especially with an economy that was so flush with cash, to slow down. And we saw back in, I think it was August or September, there's an excess cash statistic that we've been following for a while that basically says how much extra cash there is in the system. And that was a mountain. I mean, literally the graphic was, I wish that one wasn't approved, but we can share, but it was like this, record highs. And then it started tweaking down. And suddenly we're a normal spot where people don't have the excess. So the spending is going to slow. So the piece on cutting rates, that's where we're starting to see, I think, a little bit of debate out there right now. But if it does happen, it could be a tailwind.
Yeah, you know, even despite lower rates, we're seeing demand for new homes, which is really boosting residential investment. In addition, there's a ton of multifamily units under construction as well, which is running close to an all-time record. We're at a 45% above where we were in the 2019 average when it comes to residential construction. And then when we're looking at manufacturing construction, the manufacturing factor is also booming as private sector ramps up construction of semiconductors and EVs and battery plants, all on the back of support from the CHIPS Act and the IRA. In that manufacturing construction graph, we can see that from December of 2020 to October of 2023, there was a 102% increase. That's huge. But then look at the lower graph, the real computer, electrical construction spending jumped by 914% in, you know, almost 3 years. It's crazy. That's that word, Mike, crazy.
We're all feeling a little crazy Monday morning. You should have seen us about a half hour before we got started. I was like, wait a minute, my PC is dead. Thank goodness Andrew, my tech staff, will be in a little bit later today. So yeah, it's crazy. You know, the tailwind, the spend that's happening. In fact, I had a really interesting good conversation with a good friend who sells homes for one of the major national home builders. And I hadn't talked to him for a while. It's one of my daughter's good friends, the dad, and we hadn't never really kind of hung out. So we were hanging out, and I was kind of wondering, gosh, do I even ask him how business is? Because my anticipation was it's like terrible. And so I, of course, being curious, I asked questions, and I said, hey, what's going on? And he said, Mike, I'm actually having the best year I've ever had. And I was like, shocked, absolutely shocked. So of course, he bought the popcorn at the volleyball match we were at, since he was having his best year ever. But he said that what's happening with these major builders, not all of them, but the one he worked for specifically, is that they're subsidizing, they're helping with the mortgages. And they literally, the owner of this company came right out and told all the employees, it's an ESOP employee-owned company, that we are cutting our margin, we're cutting our profits on the homes, and we're sharing that with our new home buyers in the forms of discounted interest rates and helping people get into the home. So the regular residential market has this gigantic like wall up with interest rates being where they are, where the builders are building shockingly a lot of homes. And that explained why, in my mind, that they've got a well-capitalized builder. So those small builders are left out of this. I mean, the small builders are hurting right now. A well-capitalized national company like he works for is actually doing very, very, very well, and kind of shockingly well. I'll never forget him saying that. I was like, gosh, that is crazy. I did not expect that. And it's crazy. There's crazy again. As crazy as it was, I was glad that he was buying the popcorn. So that was nice. Let's talk a little bit about another factor in this whole mix, productivity.
Yeah, high productivity could boost wages while keeping inflation low. It'll also allow the Fed to ease up on rates, potentially boosting business investment, which is what you need for these productivity gains.
Yeah, and productivity is a tricky one because the higher wages, higher productivity could boost wages while keeping inflation low. It's just really an interesting stat just in general, because we've had, as you can see by that chart, productivity just continuing to increase over time. So sometimes increased productivity actually means fewer employees as well. So which actually can also lead to burnout on the job and all these other different things as well, as the companies demand more out of their employees. Why did you two look at me? You're not even, we're all independent. You're not employees. Come on, stop it. I felt them look at me. You didn't see the head change. But so anyway, productivity definitely a piece of the game that we just need to keep an eye on, again, as this crazy world continues to unfold in front of us. So a couple things that we'll always share with you over time.
Yes, remember that even if things are looking good, productivity is up, stocks might be going up, but they can also go lower. And I think we can expect to see volatility. Bear markets happen, corrections happen, as investors, we need to embrace it, not panic when it happens, and remember our long-term goals.
And that's big. And we always will share this message with you, always have, always will, that volatility can actually be a friend. And especially we've shared this message. Especially with our working clients. And your dollar cost averaging, you're buying in on a regular basis. You're buying in on a regular basis. And when the market's down, you're actually buying more of the exact same item. I've said this for 100 years. The stocks in the stock market are the only thing people don't like to buy when it's on sale. If you're a long-term investor, especially if you're in a role where you're contributing on a regular basis, volatility is not a bad thing for you. For our retirees and people that are living on their assets, as you know, we talk about this all the time. We're taking defensive posturing so that we don't ever have to be in a position to sell something that we don't want to sell. And that's where I think we need to be. So that's just a little bit on volatility. And also things to remember.
Yeah, this one's interesting.
Got it.
When it comes up, we're getting a lot of questions about this because it's making headlines. Pre-election years tend to be strong, and we'll see. But thus far, it's played out perfectly. Thus far.
Yeah, it's weird. I've been saying for the last few quarters that the stock market's acting kind of normal. And it's weird to say that because the market has been so momentum based over the last few years, where it's just like acting on emotion and acting on stuff that's going on around us. And that stuff that's been going on has obviously been important, right? It's been an important part of what we've all experienced. Now, what Wall Street started paying attention to this year is, hey, how's the company doing? Are they making money? Are they meeting earnings expectations? Are the companies setting proper expectations to get that done? And gosh, look, lo and behold, we start to see companies that are doing well and making earnings getting rewarded, and companies that aren't or making bad decisions, and Wall Street's view, of course, they're not getting rewarded. So that's a normal market. And as much as I don't trust it, I guess, because I don't trust Wall Street as far as I could throw it, which is zero. But it'd be nice. Wouldn't it be nice to have a 5-10 year period where companies are making money, Wall Street's rewarding the ones that should be rewarded, and not acting out of either fear, which we've seen a lot of that, or greed, which the greed piece is a really nice thing temporarily where markets go straight up, but that typical straight up behavior is not sustainable over the long term. So it's been really interesting to watch Wall Street do what they should do, reward the companies that should be rewarded, and spank the ones that shouldn't, and that's normal behavior for Wall Street.
And election years tend to be stronger than average returns when it is the first term president. It has been the lame duck years, so in 1960 and 2000, 2008, that have been bad for investors. And look at these graphs. Election years do much better under a new president. The blue is showing the re-elected president rate of return throughout his term. The dark blue is a new president. You can see in year 3 of a new president, average 20%, for when that happens. And then the other gold, the average years are showing much lower than the new presidents.
Yeah, that's probably been the number one question that we've been fielding from our clients and friends, family, everybody that's interested. What's going to happen? It's an election year, and obviously we wish we had that crystal ball to say, yeah, it's going to be one of those 9 or whatever % years. But historically, the election year has been a relatively strong year, in the market, regardless of if it's a reelected new president. And that average year, 8%, and 8% over the next 10 years, every year would be great. That would be absolutely fantastic. That's much higher than what we project with most of our clients from a long-term projection standpoint. So that would make everybody's situation just that much better. The presidential year, we think it's going to cause volatility. So to Marie's point earlier, we think it's going to cause volatility. We think the media and Wall Street will use division, like they've always used division, to cause investor behavior, Main Street investor behavior, to be bad. And that's absolutely their intent. They want us to make poor mistakes. They want not just you, but they want me and Marie and Susan to give bad advice, to act out of fear, to act out of greed, to act out of the things that we never should act out of when we're talking about money, when we're talking about Wall Street. So I think the election and recession, frankly, those are two big things that I think that the media could use. Wall Street, using the media, I should say, could use an attempt to shake the trees out there to get some of the weak investors out of the market and have people make really, really, really poor decisions. We're running into people almost every week right now that come in with the tail tucked between the legs saying, I kind of jumped out of the market when it got a little shaky last summer, and what do I do now? And if you missed last quarter, that was one of those quarters that we talk about, or even what the last month. You miss a time like that, your long-term return is impacted significantly. It's impacted significantly. So long-term investing always is the key, and not letting emotions get the better of us. So speaking of long-term.
Yeah, and Mike, we've kind of hammered this home here, but we know that there's going to be volatility, but long-term goals is really what we need to pay attention to. Stocks are going to go up, they might go down, but if you're willing to hold it long enough, you're likely to see some higher prices.
Yeah, and that's, as we know that, right? We've hammered that home with all of our clients, and it's during the tough times that it's easy to forget that. So, but it's also during the good times that it's easy to forget that it's not always going to go straight up. So we've had some really fun comments from clients about their year-end statements. Some clients that have taken a statement vacation that looked at their year-end statements and said, literally one comment I had was, is this right? Is this right? How did it go like that? And I was like, well, that's the benefit of long-term, right? The last conversation with that particular client was during a darker time in the summer when things just weren't picking up. It just wasn't looking great. And we suggested the statement vacation, but I find a little bit of fear in that too, because now it's like, oh, look how happy we are. Everything's super high. This is great. What we should expect and which I hope that I've been saying this to 3 steps forward, 2.5 steps back, 3 steps forward, 2 steps back. So expect that volatility that we've talked about. But again, the longer your holding period, the better. And that's how it works. Oh, more lawyer stuff. Well, we won't bore you reading all of that. You all know how to read. So we'll let that sit on the thing there. As we say, we hope that this was helpful, and as we were putting this together and looking at the different resources that we had to present, it was a little tougher this year just because of the things we talked about, because of the past, the recent history that we've had to deal with, because of an election year. We still have 2 shooting wars going on in our world. So there's so many things going on. And that's where I hope you got the message that really I think volatility is going to be something that we should expect. We've always expected it. We've always lived through it. But know that if there's questions, questions that you have about any of this stuff, so any of this stuff at all that we've covered, please feel free to reach out and just let us know, and we will do our best to answer. And if we don't know the answer, we'll just make something up, right? Oh, just kidding. Just kidding. We're here for you always, and for those that are important to you. So if anything pops up where you're having a conversation and you have friends, family, coworkers that aren't hearing this type of stuff from their advisors, we're always open for a 20-minute Ask Anything session to anyone that's important to you. So I hope this was of value for everybody. We made it. Oh man, it's only 11. I thought we were going to go 2.5 more hours. Darn it. Well, we made it out in 30 minutes. So I hope, again, this was a valuable use of your time. And on behalf of the entire team, greatly appreciate that you chose to spend this time with us today. And as always, we are a resource in the background for anything. So don't hesitate to reach out if you need anything or have any questions at any time. So thank you all. Thank you all for tuning in. This will be up on our website, pending approval, relatively quickly as well. So we'll send a notice of that out. So if you want to hear it all again, or if you need a sleeping aid, just tune it in. Tune it in. Thank you all. Have a wonderful day, wonderful week.
Thank you.